Hey guys, welcome to another episode of Thinking Like a Bank, where we show you how to think like a bank by applying the same strategies and principles that banks use to help you find more financial freedom in your life. I'm your host, Sarah Ibrahim. With us today, I have Vijay Kailash. He is a chartered financial analyst. He's been an entrepreneur since a very young age. His businesses have ranged from selling Mountain Dew out of his locker in eighth grade to investing in real estate starting at age 23. After achieving lean financial independence at age 26, Vijay officially left his safe and steady corporate job in January 2022 and launched a hedge fund specializing in income-producing strategies for accredited investors. In addition to running his hedge fund, Vijay is the host of the Vijay Kailash Show Podcast, where he brings on guests to discuss entrepreneurship, investing, and self-improvement. As Vijay has been an advocate of financial education and entrepreneurship for over 15 years, Vijay teaches his firm strategy for free on his website, vijkailashshow.com, and I'll include the link to that in the show notes below. I'm excited to introduce the founder and portfolio manager of Kailash Capital Group, Vijay Kailash. Welcome to our show.
Thank you so much, Sarah. It's great to be here.
Yeah, thanks for joining us. I've been looking forward to this interview for the last couple of weeks. I think this is going to be really important content for the audience, especially in the economic times we're in right now, mid 2022. I think this is going to be really useful for the audience. Before we jump into the investment strategy you're going to share, do you mind sharing with us more about your background and what you do?
Yeah, I think you nailed it with the little bio read right there. I've always been an entrepreneur since the beginning of the eighth grade. My first business was selling Mountain Dew out of my locker. And at that point, I realized, hey, you can actually make money without actually working for someone. So I always found ways to make money, including teaching guitar and drums. Actually bought a few cars later on and rented them out to Uber drivers. And I got into real estate investing, where I literally lived in the smallest room of my house and I rented out each of the other rooms. And so I did that with two houses. And so basically saved up enough money, just continued investing. And then this was all while I was still employed. And then eventually I was making enough money with my real estate and my other investments to leave my safe and steady corporate job in January 2022 and start up my hedge fund, where we specialize in trading options. And so, as you mentioned, my background is investment management. And so it's something I've been doing for over 6 years on the side, not even related to my actual job. But I came across this strategy and I'm like, this just makes so much sense. So I started doing it in my own account. And then when I was doing it in my own account, I started talking to potential investors. I'm like, hey, this is what I'm doing. Is this something you'd be interested in investing in? And after they said, yeah, once you start, let's do it. And so, raise some soft commitments, while set up the legal entities, all that, wired my money, and then officially left and have been, I guess, a full-time entrepreneur since January 2022.
And has there, I'm guessing I know the answer to this, but has there been a big mindset shift between being an employee to now running your own hedge fund?
Oh, 100%. So as an employee, right, when you're salaried, you do the bare minimum to get the maximum result, right?
Yeah.
And because it doesn't matter, you get paid regardless of what happens.
Yeah.
But as an entrepreneur, it's like no matter how much effort you do, you still don't get paid at the early stages, right? So it's kind of like I'm working almost triple the number of hours I am now than I was when I was employed, for none of the pay. In fact, I'm paying money to do what I'm doing right now because there's so many, overhead costs for starting up a business and doing all that. So it's huge mindset shift. It's like you have to absolutely love it or be able to get through the hard days, because there's no one else coming to save you. As for, employment, you could just be like, all right, take a sick day or whatever. You could do that here, but just know you're not getting paid.
Yeah, exactly. Like, for example, if you're working at a company and you have 2 weeks to come up with a report or project, you're getting paid during that time. And then after you submit it, you're still getting paid and then moving forward. Whereas entrepreneurship, you could spend a month writing blogs, going on podcasts, doing research, and nobody's going to pay you at the end of that. It's not guaranteed.
Yeah, actually, you're paying money to do that almost, right? You're not even getting paid. You're just trying to break even at that point.
Exactly. Yeah. Yeah, definitely. So it's a big mindset shift. In your bio, you mentioned, financial independence at the age of 26. And I think that this has different meanings for different people. So in your opinion, what is financial freedom or financial independence?
I love that question. So if you ask 100 people, most of them are going to tell you the same thing. It just means do what you want when you want without having to really explain it to, I guess, anyone else, right? If you don't want to work, you don't work. If you want to go on vacation, you can. Or if you want to do something productive to society, you can, without knowing, hey, I need this job to to survive, right? Or to feed my wife and kids or whatnot, right? That's the whole point. Actually, a few weeks ago, I went to a silent retreat where you just go sit in silence for 3 days. Life-changing experience, by the way. And during that, we just meditate from like 6:30 a.m. till 9:30 p.m. Just lots of meditation and quiet, but we had some like recording playing in the background uh, about meditation. And one of the prompts was close your eyes and imagine in 7 days the world's going to end, or in 7 days you're going to die. What would you do? And when it comes to what do you really value in life, I think thinking about that, I have 7 days left. What would I do? And I think that's the first thought that should come to people's minds, right? Like, if this is what you would do, right, that actually tells you what you really value in life. It's probably not your job. It's probably not doing these, small things here and there. It's actually most likely the thing that brings the most value. For me, it was, hey, I want to spend time with the people I love the most, right? And that's usually a common theme that comes across, but I think it's a great exercise for everyone that's listening. Just close your eyes, think about it. If you're going to die in 7 days, I know it's very grim. What would you do? Right. And I think that kind of changed my life and the way I try to operate every day with a purpose, because no one knows when their last day is. Right. And we're just, as long as we wake up every day and continue doing what we love, but not just what we love, but something that adds, I think, value to society. I think that's the reason I love entrepreneurship, because it gives you that freedom. And that's why I love financial independence. So then I could become an entrepreneur without worrying about, oh my gosh, how am I going to feed myself?
Yeah, and you're right. It's not just a perspective, but it's the truth, right? We don't know when our last day is going to be. There's really, it's really hard to tell. It's kind of scary in a sense, but at the same time, motivating too, because, sometimes I talk to people and they're like, oh yeah, I'll just start a business in 20 years. It's like, you don't know that you'll be around in 20 years. You don't know if you'll be around tomorrow. So I love that, how you mentioned that, and really kind of gripping life and kind of getting the value. And it's not just about money, like financial independence, but also about living life and valuing things, because people have different values, and knowing your values and sticking to them. So part of your investment strategy, does it help people find or seek financial freedom?
I think so. So I am, part of a bunch of FIRE groups. If you're not familiar with that concept, financial independence / retire early. And a very common way to invest is to invest in index funds, right? You make $100, you take it, you invest it. And basically with that $100, you get diversification across hundreds, if not thousands of companies in the US or internationally. So that way you don't have to pick any individual stocks. And so I think that's a great place to start. But what I do is I take that as a baseline, and then I add options, derivative overlay on top of that. Basically, I can create additional income on top of what the FIRE community is already doing. They get you, I think, 70% there. I take them from 70 to the 95%. And, I don't think you can ever get to 100% where it's like you're guaranteed money forever, but this gets you pretty close. In the long run, you're going to make money with if you know how to trade options, and not just options, like any type of asset class. If you understand how to invest in real estate, you're going to make money in the long run. If you understand how to buy individual companies in the private market, you're going to make money in the long run, right? It's about honing in your skills, figuring out what you really love and being really good at it to make you money. So for me, I found that to be options. It doesn't necessarily have to be for everyone, but for me, that's what it is.
And then 2 questions. So first question is 70 to 95%. What does that mean?
Oh, I was just saying, like, the financial independence, like investing in index funds gets you 70% of the way to, I'm just using arbitrary numbers.
Gotcha.
To get better returns. And I'm just using 95 as an arbitrary for me, saying that, hey, with this option strategy, I can actually increase my returns and lower risk. Maybe not to 100% of the ultimate goal, but still pretty close.
Okay. And then, so like, for those who don't know, like what are options?
Yeah, actually, I just released a video about this morning, so very, very fitting. And so options, think of them as financial contracts. All right. All they do is it lets someone either buy or sell a stock at a certain price on or before the expiration date. And I know with this podcast, we don't have too much time, so I'm just going to, I guess the best way to explain in a short amount of time, there's 2 types of options. There's something called a call option, and there's something called a put option. Now, you can be a buyer or a seller of either of these, right? You could buy a call option, or you could sell a call option. You could buy a put option, or you could sell a put option. And so based on where you are on this trade, you can either collect income, or you could basically buy the right to either buy or sell a stock. And I know this gets a little bit over a lot of people's heads. If you're like, I have no idea what you're talking about, totally understand. I mean, I know it's a 30-minute podcast. I don't want to take up the whole time, but check out my video. Just type in Vijay Kailash options on YouTube, and I'm sure you'll find it.
God, okay. So and this is different than just buying a single stock, because the options is like a risk mitigation strategy or tool. So it's almost like an insurance policy on the stock. Did I say that correctly?
That's exactly it. That's one type of option. Yep, that's one of the put options. That's actually analogous with insurance. Okay. So that's actually a great segue. I know you and I talked about this earlier about my strategy and like how that kind of leans into it, right? Mm-hmm. It's with put options. Think of it like insurance, like car insurance, right? Yes. Every 6 months you pay your insurance premium. Best case, you don't crash your car. What happens to that premium? You just end up losing it.
Yes.
And the insurance company keeps that money. But if you do crash your car, the insurance company buys the car from you.
Yeah.
Basically, what we do is we are the insurance company. Yeah. We sell insurance, not on cars, but we sell insurance on the stock market. So if the market doesn't crash, we're able to collect a lot of premium, like very good income. But if the market does crash, we become obligated to buy all these incredible companies at a lower price.
Okay.
And so no matter what happens, and remember, this is just with just using car insurance as the example, right? So if the market doesn't crash, we make 25 to 30% every year just in income. If the market does crash, we become obligated to buy all these great companies at a lower price.
Okay. And then what I'm hearing is that it kind of doesn't really matter whether we're in an upward market or a downward market.
It does matter in the short term. It absolutely matters because our returns can fluctuate. Because let's say I become obligated to buy the stock at $95 because I sold insurance, right? But now the stock's trading at 70. I have to take a $25 unrealized loss. But because I'm so bullish on that stock for the long run, I'm okay holding it because I know my investment horizon is 5 to 10 years or longer. But in the short run, I don't know if it's going to continue dipping. It may just stay flat. A lot can happen in the short run. So there's still a lot of risk in the short run. But I'm comparing this to the alternative of the FIRE movement, where they just buy index funds, right? You buy an index fund, and if the market doesn't fall, or you buy an index fund and the market falls, you're kind of just stuck holding it.
Yes. Yeah.
As for this strategy, we are obligated to buy on the way down, which is exactly what we wanted to do since we're long-term buy and hold investors.
Okay, that makes sense. Got it. Okay. And then like, how about the impact of interest rates? What impact does it have any impact on options?
Yeah. So there are some, so the way to price options, there's something called the Greeks. There's 5 Greeks, and rho is one of them that stands for interest rates. Unfortunately, it's one of those which are kind of just like, no one really talks about it because interest rates don't really impact options prices because interest rates are meant for, I guess, longer dated options. So for those who are, again, this is like going very, very technical, very detailed. So I'm sorry if I lost all of you, but but with rho, basically with interest rates, it doesn't have an impact in the short run. The types of options I trade, it has very little impact. So it almost doesn't matter. But certain options traders, it can have an impact if they trade longer dated options that expire in 1 or 2 years.
Got it. Okay, that makes sense. And you mentioned like index funds. I understand. I get that logic where like if they decrease, then you kind of have to either wait until it goes up or sell at a loss. What's your perspective on other types of conventional, traditional investments like mutual funds and, I guess the ordinary investments that everyday people kind of utilize?
Yeah, so index funds are a type of fund which ordinary people should be utilizing. So mutual funds, what they do is they pick individual stocks. Usually, they say, okay, out of the universe of investments, I'm going to pick these 20 companies because I think these are going to outperform the benchmark, which being the index fund, right? Or being the index. And so what happens is these mutual fund managers actually underperform the market, as in they're charging all these fees and they're earning less return.
Yeah.
And so mutual funds are probably not the best way to go.
Yes.
But ETFs, which stand for exchange traded fund, they can be a good way to go potentially based on your investment horizon. Again, everything I'm talking about here, not financial advice. It's purely just for education, and we're talking more for the long run. These are for long-term investments. In the short term, there's so much risk.
Mhm.
If you're like, hey, I need this money in the next year or 2 years, we can go into a recession and you may
Yeah.
have to sell at a loss if you absolutely need that money. So don't do this for the next few years. This should be a longer term kind of strategy. And so, sorry, what were you asking about?
Yeah, just like the problems, like, because I think because I talk to clients a lot of times and they're like, oh yeah, I have index funds, mutual funds, ETFs, I'm good, like I'm set for life.
Yeah, and I think it's a great place to get started to build good financial habits where you're putting money away to invest in the stock
Mhm.
market. That's exactly how they're investing. But if that's all they're doing, I think there's more efficient ways to achieve financial independence, such as starting a business or real estate or being
Yeah.
a limited partner with someone else
Yeah.
who knows what they're doing with more, I guess, um, higher return potential assets. And so the stock
Yeah.
market's incredible to just get started and build great financial habits. And in the long run, you're going to become a millionaire. That's just mathematically, that's just how it's going to happen. But
Yeah.
it's going to take 30, 40 years.
Yeah.
Right now, you could fast lane that to the next 5 to 10 years if you understand how money works and you're able to find better lucrative investments, such as starting your business or real estate or being an LP with someone else.
Yeah, exactly. I interviewed a lot of general partners and limited partners of real estate deals on this podcast. And yeah, it's very like from the research I've done, it's not that hard to double your money every 5 years in real estate. That's like kind of like the bare minimum of what people aim for in limited partnerships that I've seen.
Yeah, exactly. That's right. I can't speak for every LP, but
Yeah.
that's exactly how it can be a lot more lucrative. Yeah.
Yeah. Yeah, definitely. And so like a lot of our clients use cash value whole life insurance. So they've set up these life policies with cash in them and they could leverage that cash for other investments. And the reason why they do that is so they could earn higher rates of returns outside of the policy, because the policy is only going to give you a very conservative return, like 3%. It's very, very tiny return. So they would leverage the policy to invest in different places. And the foundation of the policy is secure, right? Because we work with 3 different life insurance companies, and like other life insurance companies, these companies have been in business for like over 160 years, and their portfolios, their general funds have been growing every year, regardless of whether we're in the Great Depression, recession, the dot-com crash, 2008 crash, COVID. They've constantly been growing. And do you happen to know, kind of from a derivatives perspective, like what are insurance companies doing that allows them to continuously grow money regardless of the economy we're in?
Yeah. So this was actually what I did professionally. We manage money for insurance companies. At least I was on the business development side, so I kind of understand the theory of it. But they invest in very, very safe assets such as bonds, right? And when I say safe, as in you're still losing money to inflation, it's not very, uh, it's not necessarily the best place to put your money. But legally speaking, they couldn't go too risky because there's actual regulations on what they can and can't invest in from a risk standpoint. Because imagine an insurance company collapses because their investments got too risky
Yeah.
and they had to pay out premiums. That means they have to sell all their investments at a loss.
Yeah.
Right. And so that can cause a lot of economic issues. And so because there's regulations on what they can and can't invest in. So usually insurance companies, they have to keep about 70 to 80% in fixed income, basically bonds, very safe, conservative assets. And then they can maybe have 5 to maybe 10% in alternative investments. But it's a place where it's trying to get, it's very difficult to navigate in very low interest rate environments.
Yes.
And so they basically just have to continue collecting more premium and just raise their prices. And that's kind of how,
Okay.
so it's not that they're always making money, it's just they have to stay solvent. I think that's their number one goal.
Got it. Okay, that makes sense. And then the 5 to 10%, are they doing like options trading and other a little bit like different types other than bonds?
Yeah. So these are just alternatives in general. So they could be investing in infrastructure. They could be investing in real estate, private real estate, could be investing in a bunch of different things. And so they could be using options. Really depends on the company.
Okay.
Right. And options can be used to actually hedge against risk. So if they use options in that way, they can probably use it to lower their risk in their insurance or in their general account holdings.
Got it. Okay. And then back to, I've actually interviewed general partners who said that they've used life insurance companies for loans on real estate deals. So that's probably another source of income or growth for the life insurance companies, is to loan to, like you mentioned, to syndications and other deals like that.
Yeah. I guess that could definitely be another source of income. I mean, there's many ways that they can make money. So I know one of them was investments they have all this money sitting in cash, might as well invest it, collect an additional income. But of course, they make a lot of their money on the premiums they collect from insurance policies.
Absolutely. Yeah. Yeah, definitely. And as I was reading your bio, I noticed that it's a hedge fund for accredited investors. Is it, I guess, only open to accredited investors?
Yeah, at this time, it's only open for accredited investors. So that's 1.1 million in net worth, excluding primary residence, or 200,000 in income every year for the last 2 years. Yeah. Do you have, I know you have your website, you have your podcast. Do you have like a book or ebook that you can give away for people to learn more about your strategy? Yeah, so I don't have an ebook, but I do have a fun PDF on my website. So it's actually on literally my homepage. If you go to vijayKailash.com, the PDF's right there. It kind of walks you through our strategy and just how you can implement it in your own portfolio. So whether or not you're a client, it's just giving away free information. So enjoy it. If you have any questions, definitely reach out. There's places on there for you to contact me, but also Instagram or LinkedIn is also another social media I'm pretty active on.
Got it. I'll add in all your links in the show notes below, your LinkedIn link, your email address, all your contact information. So that way it's easier for people to contact you and network with you and connect with you.
Awesome. I appreciate it, Sari.
Thanks for being on the show. I'm looking forward to having you on. And it was nice talking to you.
Of course, man. Take care.
You too. To learn more about what we do and how we can help you grow more wealth, please visit www.finassetprotection.com. That's FIN assetprotection.com. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.